Welcome back to another Trading Justice podcast. Really excited to talk about the markets with my brother Matt. We're going to break down the technicals. We're going to have a little fun game about the 10 bearish arguments that are out there in the market right now. We're going to discuss those, rank them on short and long-term importance. We're going to have a transitory conversation on the Fed in what I thought was a sneaky important Fed meeting. Lots to discuss on that from both a, oh, this isn't good, and oh, this might be good for bulls perspective. Before we get into any of that, my brother Matt, who I will be talking with in just 5 seconds, and I did a fantastic webinar this past week on day trading. Day trading has, Matt, even like cash flow traders like myself are using intraday analysis to make really important decisions. Right.
Well, and that's what I wanted to get across the point when in the day trading mastery webinars. This is not just about executing day trades. It's about understanding how time frames work into longer time frames. Intraday analysis in market corrections, I'll tell you, the daily analysis is starting to become a little bit more important, but intraday analysis has been the end-all be-all of all technical analysis over the course of the last month or so. And so in that day trading mastery webinar, we focused on, yes, day trading and what is day trading and the strategies, but we spent a tremendous amount of time talking about the intraday side of the equation. And so if you are interested in learning intraday analysis, day trading strategies, and have interest in short-term trading, you're definitely going to want to check out that day trading mastery webinar. Link in the description below. Catch the replay. We had a lot of fun.
That's where you have to build those skills. Unless you're just a buy and hold, sit on your butt type investor, you have to have those skills.
And then you need to embrace the cash flow skills, the covered call side of the equation.
And be sure to check out our newsletter this weekend. It's been spot on. It's told a really good story of the market. It is just one of those newsletters, one of those products out there in the financial world that will help you navigate all scenarios, the ones where we're trending nicely and the ones where we're not.
Yeah, don't sleep on the newsletter, pros. Definitely check it out this weekend. It's the best way to get in front of the news stories and the analysis and the entire conversation that's going to happen next week. And so if you want to truly understand the market, understanding the themes, the impact, and kind of expectations for the future, we have videos, written articles. It's a fantastic newsletter. Definitely check it out. If you're a pro, obviously that's your homework on the weekend. And if you're not a pro, come over there, sign up for a free trial of the pro membership, and check it out.
You know, I want to get into the Fed and in the bearish arguments because I find these conversations coming up very interesting, very important. But we're going to start like we always do with the technicals. Now, I could, I was joking with you earlier, I could listen to a technician for 18 straight hours talk, but I wouldn't probably this week because it's a pretty simple story right now of know your ranges, know the key levels that if they break either way. Matt, break down that simple story for us right now.
Well, yeah, and we talked about this in depth in the newsletter, and you are right. It's a very easy technical story to understand. However, there's a lot of complication to that from a multiple time frame. But the simple version of the technical story is think about the current environment as a K-trade scenario. Where last week, what were we expecting? We were expecting that.
And the K-trade, for those that don't know, is a bullish bearish scenario.
Yeah, and when you're looking at it, last week we expected kind of that bearish retracement phase to begin. And that's exactly what we got. We got that nine tester kind of sniffed up into that 200-day moving average. The Dow Jones came smack dab into the 200-day moving average, but bearish retracement phase began. Now, because of the intraday analysis over the course of the last 4 to 5 trading sessions, the market is showing you that the bulls are fighting a little bit here, and they have not been fighting at all. And so when you're looking at it from a base technical perspective, understanding the zones where bias might change is extremely important, meaning if you're neutral in this current condition, where would you increase bullish bias? If you're neutral in this current condition, where would you increase bearish bias? That, to me, is the most important part of this technical equation.
And I love that. I'm going to repeat that just because I think that sums up the whole market right now. What point do you increase bullish bias on the chart? What point do you increase bearish bias on the chart? I think that pretty much
Well,
sums up.
And to me, there's two levels that stand out in the short term that are going to be challenging. On the support side of the equation, it's 550. It pivoted last week, or basically a week ago Thursday. That was the pivot point right there at 550. And when you look at that support level at 550, there's not a lot of historical support, meaning that is something that we need to track. Because if you violate 550, there's really nothing until you get to 525, 526, which is kind of like, Mark, when you can't find a support on the daily chart underneath 550, and you can't find a support level on the weekly chart underneath 550, and the only support underneath 550 is 526, where the monthly 20 period moving average is, you know that level, you want to increase bearish bias if you break that level. That level is a very important short-term level that the bulls and the bears obviously will track. It's a minor pivot as of this point, however. Now, on the resistance side of the equation, 573 stands out to me. 573 is the combo 200 20 period moving average on the daily chart. You break back up above that. The only thing you got above that is really the 50 daily at 590, and then you have the 90 MA on the weekly chart at 582. And so you look at that 573 level, and you're saying, okay, we could probably get 7-8 points above 573 before we get into anything too challenging. And if we break 550, there's really nothing until about 526. And so
that's a big freaking range. That's why you pay attention to these levels.
Well, listen, if you break that support with velocity, that's going to be a quick journey to the downside, very similar to what we've seen in the first place. So I do think the technical conversation is a fascinating one that I could spend literally this entire hour in the podcast talking about it and detailing it. But as of right now, for the podcast, I think the most important thing is understanding these levels, because at the end of the day, we triggered a market correction a week and a half ago with the 10% clip in the S&P 500. At this point, it is the ultimate question. It is a matter of, is this just a correction, or is this something beginning something new? Well, to answer that ultimate question, obviously there's a billion data points on the fundamental side and the geopolitical side and the macro side right now.
Yeah, we're going to talk about those.
And we'll talk about those, but the technical side's pretty clean. 573, 550, those are the levels.
Yeah. Now, 5 more charts I want to fire through real quick. QQQ, NASDAQ 100. These levels are even easier to see on the NASDAQ, right? The range is a little more compressed. Same logic. Do you see anything different on technology?
I don't, not yet. The only thing I see different in tech, IWM versus the SPY is the move to the downside before the retracement phase started beginning. And so you had more selling pressure in Qs, you had more selling pressure in IWM. That created a scenario where you're underneath the 200-day moving average and you're developing underneath the 200-day moving average, whereas with the spiders, you're developing kind of at that 200-day moving average. But in the ultimate short term, meaning the last week of price action, I'm not seeing a fundamental difference in the indexes, quite frankly. They're all kind of trading a little bit similar. I do expect those to start separating this week, though.
Yeah. Let's go to gold real quick. In the midst of the chaos, we talked about this in the newsletter as well. Commodities have held up very well. It's about next pattern for me, right? Do I get a pullback? Do I get a breakout? As far as new things, obviously the case for gold has been made by us many times on this thing. Anything special you're seeing on the chart right now?
No, I'd love the comment in the newsletter this week. Commodities pulling back a little bit. Silver pulls back 2-3 days. Copper's not pulling back at all, sitting at the top. Gold's strong enough that it can only deal with a 1-day pullback and hammer off that 1-day pullback with a clean test against the 9 EMA. A lot of confidence on the gold side of the equation. I got this slightly overextended, but just slightly overextended. Any high base would play here, but gold's very strong right now.
Yeah, and then just give me crude oil and Bitcoin, because I just think it's funny that they're both trading on the same algorithmic program.
Funny.
Both had sell-offs. Both have been attempting to bottom, putting in very similar pattern. It's almost like they're trading like almost like, formation for formation in recent weeks.
Bitcoin's been compared against many commodities along the way. I'm not sure it gets a lot of comparison against crude oil, but then again, that's kind of what the short-term side of the equation has done. You look at crude oil sitting at a massively important support level. Well, not sitting at it. 65 is the massively important support level, but improving conditions, consolidation, bulls starting to fight back a little bit. You look at Bitcoin, very similar conversation, obviously coming from different perspectives, but Bitcoin, selling off short-term downtrend, now trying to fight the 200-day moving average. And when you look at really just the immediate short-term, look at the kind of the slow drift upward movement.
That's what oil's done. I mean,
and you look at oil, and again, you're just looking at it in the immediate short term, slow drift upward movement in price, maybe a little bit more aggressiveness because you got above those moving averages, but very similar. In fact, I think you could easily do a good little game. Which one do you prefer at support? Do you prefer crude at support, or do you prefer Bitcoin at support? How would you answer that?
I trust crude more than Bitcoin at support, just because I have a massive support level that's already been tested over the last year.
Oh, it's battle hardened at 65.
It's just been, you've had like 75 tests, and I'm exaggerating a little, but you've had a lot, in that same support zone.
See, and I think for me, I do prefer the Bitcoin, just because I have a little bit of a different take longer term. I don't like either one of them in a short term. I think both of them.
Yeah, but all I know is the entire market from a cash flow perspective, which is what I do, has been fantastic. May it never end. Like consolidation,
slight upward move of price after a volatility event.
Consolidation, slight after volatility. Like the whole thing has been a cash flow paradise the last couple of weeks. And you're needing some like intraday knowledge to take advantage of that, but it's been fantastic. It's been absolutely fantastic.
Well, they always say cash flow's first in the door, because all you guys need is a little bit of
I'll give you a pattern on that. It's not in stock in the news. There's a couple other charts I want to look at that. Give me Microsoft. This is a chart. When I look at Microsoft, it is a very easy cash flow chart. I have a support level that if it gives out, okay, get out of the thing. Wrong, be defensive, whatever.
Getting above the 20 period.
Getting above the 20 with confirmation potential after a big sell-off. That is a fantastic cash flow.
Moving averages don't always work, but this one has some, like right there, kissed off the 20 really clean. Now you're getting above it after consolidation, slowing momentum and trend. I can see why you really
it's these type of patterns, and I like tech over everything else. I've been very public about that.
Now, try to make an argument on the directional side on.
I'm a cash flow guy.
That's my point is, like, on the cash flow side of it. Yes, you have.
I don't need upward movement to benefit.
You need sideways. You need.
I need
selling to stop.
Yes, that's all I need.
And for me, it's not just a matter of the seller stopping. We need to see those buyers step in, and we're starting to a little bit. And again, this is kind of what I've been talking about with, there's the intraday side of the equation is shored up enough that the daily chart is starting to become more important. The daily chart hasn't been important for 30 days in the market.
You break that resistance, it becomes important.
It becomes more important. Exactly. And so we're starting to see the early signs of slowing momentum on the bear side, Indicators across the board confirmed that, by the way, and they've been confirmed it for 2 straight weeks. Last week, literally in the podcast and in the newsletter, we talked about bullish divergence on RSI and slowing momentum on MACD. You look at those from an indicator perspective when you're looking at the market here, Chucky. You look at, for example, MACD here. MACD got the hook last week, got the cross this week. It's coming from an very overextended side of the equation. I'd like to see another day up, but you're seeing these improving conditions, Mark. And so whereas everybody is still trying to grapple, and when I mean everybody, I mean like the majority of market participants still trying to grapple with the previous volatility, to me, that's old story. Now it's a matter of what patterns develop at these key levels, because that's going to be the most important thing moving forward.
Yeah, I'm a trader. I'm firmly in the bear camp on the macro side, but I've been a rentable on the cash flow side recently and how I've positioned, because particularly in tech, I really like the cash flow on tech.
Listen, I got tech moving with the market right now. You have been talking on tech side for a week now.
I think it outperforms. I do.
I think you've said that literally 19 times this week.
I have a t-shirt that says, Mark, I'm a bear, but tech outperforms from here. Like, give me
the 1 minute, 30 second.
All right, here's the reason why. And I've talked about this on the podcast and on that. And we'll talk about this in the macro things. We're going to have this game where we're talking about the 10 bearish arguments. Mm-hmm. The market is insane right now as far as the analysts on CNBC. They don't understand what has happened. You and I are firmly on this sell-off did not start because of tariffs. Has there been intraday volatility?
Tariffs might have been the headline causation and the headline reason, but it's not the reason why it continued to sell off.
If tariffs were the reason, your average stock is measured by RSP would not be basically up on the year.
Yeah,
that's insanity.
Listen, and again, and not only that, Mark, but you wouldn't have seen international markets go up. Yes. You would have seen all markets go down.
And this is what the mainstream media, financial media, is not getting an understanding at all. And it's
because they just want to have the political conversation. They don't want to have the real conversation. They just want to bitch about the politics.
If volatility hits, it's going to hit later. This has not been. This has been
a heavy positioning.
This has been a heavy impact everything. ARC, Palantir, all of your Mag 7, all of the shinies, right? That's the stuff that got hit hard.
And those were heavy positioned.
And
heavy.
Everything that sold off was heavy positioning. Those areas of the market where people were, being too aggressive.
Yeah, to me, the combination of and again, when the heavy position sells, it does bring everything down. Like when Mag 7 sells, the market's not going to go up when Mag 7 sells. But when you see Mag 7 sell like it has in the aggressive areas and all that, you would expect everything to come down in the short term. We're going through a correction, obviously, but you would most likely see more selling in RSP. Not
the things that are actually disproportionately impacted by
RSP is outperforming SPY. If this was solely a tariff conversation, I do not believe international markets would be outperforming Mag 7, and I do not believe that the RSP would be outperforming the SPY. And so, yes, it is the tariff conversation impacting volatility and impacting confidence and is that uncertainty leading to some of this volatility? 100% it is. Of course it is.
When tech led the selling in 2022, it made sense to me because you had an interest rate conversation. Historically, tech and growth tends to suffer the most in those environments. So tech leading the selling made sense. It makes zero sense in this environment.
I think the number one problem with the administration has been the uncertainty of the conversation, not the conversation itself, but some of the uncertainty regarding exactly who's getting tariffs, who's not getting tariffs, what percentage of it. That becomes chaotic for the pricing elements of the marketplace.
Yes.
However, that's usually a short-term situation, not a long-term situation. To me, like, I'm not a tariff guy from a broad-based perspective, but I do support targeted tariffs. I absolutely support targeted tariffs. I think the number one tariff that we absolutely have to have is on the semiconductor side of the equation with China. And we've had that for, I think Trump put that one on in what was that? Well, that was one of the early ones in 2018 with tariffs on China. That the Biden administration continued that policy. The Trump administration is continuing that policy. Nobody in America is debating the viability of tariffs on China regarding the importance of bringing back production to the United States. On the manufacturing side of the equation, we're starting to see manufacturing come back a little bit on the targeted side of the equation. FCX, for example, came out with a note this week on tariffs that said tariffs are going to be very positive for
Well, yeah, for FCX, they're going to be really positive.
Everybody's going to want their copper. But my point is, broad-based tariffs will always be seen as a negative to the growth side of the equation from a market perspective, because they are inflationary based and they are concerning to the consumer. However, targeted tariffs, and again, like, that's kind of where the conversation has been. I'm going to target this, I'm going to target that. Targeted tariffs, when you're targeting industry production coming back home, can be very good on the growth side of the equation downstream. And I just want to say this. I know we get caught up in the market conversation so often, but post-pandemic, the world has changed from a trade perspective. And I do think it's important to have these conversations, because the supply chain did change fundamentally post-pandemic, and we cannot go about international trade policy in the exact same way post-pandemic as we did pre-pandemic. And so, yes, it's complicated. It's causing confusion for the market. It's overwhelming at times, but I'm not sure that this conversation is not absolutely needed and absolutely warranted. I would just ask the administration and to be a little bit more consistent in the application of the tariff policy, because I do think it's the uncertainty of universal tariffs versus exactly what is going to be occurring on the targeted tariff side of the equation that is creating the majority of the concern here. And so I know we weren't going to talk too much about tariffs here, but I just wanted to give that.
We're going to talk about it a little bit. And I have a little bit different take on the importance, but we're going to save that for the 10 things. Let's get into the Fed, Matt. Listen, we could do a whole podcast just making fun of Jay Powell for using the word transitory. I could not believe it. And I don't think anyone could believe, because the Fed spent some time on tariffs in their Fed meeting this week, and we're going to talk about some of the highlights.
Couple times.
And Jay Powell dropped the tariff inflation will be transitory. Austin Goolsbee on CNBC did the same thing Friday morning. I cannot believe, and I'm not alone, that the Fed is going the transitory route to describe inflation after their debacle of the 2021-2022 inflationary saga. Why would you not choose a different word?
I have no clue why they would want to remind the world of the number one policy error at the central bank in the last 40 years. I have no clue. That word transitory should be banned at the central bank, and Jay Powell should never be able to use that word again. I just want to say two things on the transitory conversation. Number one is inflation is never transitory, and this is gaslighting at its finest. Inflation is never transitory. Everybody say it with me. Inflation is never transitory. Inflation goes up over time. We literally target inflation to go up over time. We're having the hardest time getting inflation back down to 2%, but 2% is still an increase in inflation, or an increase in the price of cost of goods and services, and thus it's not transitory. Whether inflation is at 1%, 2%, 3%, 5%, 10%, it's never transitory. That word is gaslighting. It has always been gaslighting. And it was a mistake to use it in 21-22. It was a mistake to use it this week. It should never be used by Jay Powell ever again, because once it again, the only thing it does is remind a healthy host of market participants of the number one policy error. And let's go back and look at that policy error for my second point very quickly. When they said the word transitory on inflation, they were looking at a complicated geopolitical environment post-pandemic, and they were assuming that the supply chain post-pandemic was going to heal, and as the supply chain healed, inflation would therefore be transitory. The problem with the central bank is they misread that very complicated geopolitical, economic, inflationary environment post-pandemic, and whereas you and I were screaming The markets are not going to be the same post-pandemic. The supply chain's not going to be the same post-pandemic. Economic systems around the world are going to understand one very key point, that we cannot allow our production to live outside of our country and have to rely on getting, vital goods in a scenario like a pandemic. We can't rely on China. We can't rely on Europe. We can't rely on others. We have to rely on ourselves. And that wasn't just us saying that. If you listen to any politician post-pandemic, they were saying that. And it was outside the US, it was inside the US. And despite all these countries talking about it, and despite all these politicians and leaders talking about it, despite the World Economic Forum talking about it, Davos talking about it, everybody talking about it, here's the central bank and Jay Powell saying, guys, it's just transitory. And that allowed them to keep a very, very dovish monetary policy while they were continually increasing the M2 rate, and inflation was just smacking us in the face. And while that was happening, here's Jay Powell, it's just transitory. Well, let's fast forward to the current environment where we're dealing with a complicated geopolitical situation that has everything to do with the exact same conversation that we were having 3-4 years ago on the complicated economic environment post-pandemic, how our country's going to respond to this. You can't tell me exactly how Europe is going to respond to this tariff war. You can't tell me how China, Russia, Africa, South America, any country around the world is going to be responding to this in a month, 2 months from now. And here's Jay Powell coming out and saying, hey, guys, this very complicated geopolitical environment where every country is having a different opinion. And you know what? It's just transitory. And so is that what we're going to do now in every single complicated geopolitical environment? Just say it's transitory? That is absolutely asinine to me. That is crazy.
The Fed needs to back off this right now. Because
they have to eliminate that word.
You can't have the institutional powers. You can't have markets questioning them. Right,
I'm openly questioning the viability of what the Fed is doing here. It does not lead to confidence downstream. I did not see Jay Powell this week as a leader. I saw him as a man who's trying to figure things out in public. I just felt like
this is what I saw Jay Powell in the press conference. I saw him use the word uncertain 16 times. Fair enough, right? Fair enough.
Okay, but you can't uncertainty 16 times and then say it's transitory.
I know, exactly. That's the point I was going to make.
Who the hell is there no analytical people left in the world? How does everybody hear that? Hey guys, the world is uncertain. I'm going to say it 16 times. Tariffs are creating uncertainty. I'm going to say it 16 times. For 45 minutes, I'm just going to talk about uncertainty, but then I'm going to describe all of that uncertainty as transitory. How are these people leading the central bank of the United States?
The more time I have had to think about it in the last few days, right? Because this is how markets, individuals, right? It happens. You get the data. You have a night to think about it. You're back to trading and work the next day. And the more time I've thought about it, I thought this Fed meeting was a disaster, except for one thing that I'll bring up here in a second for bulls.
Well, and not only that, Mark, was it a dovish tilt? Was it a hawkish tilt?
Well, I mean, it was a mess. I mean, you think about it, they lowered the GDP forecast to 1.7 from 2.1. They raised their inflation.
Big downgrade in GDP for the Fed.
I have a question for you, Jay Powell. Can you see the stag or the inflation yet when your own data is saying growth going down, inflation going up? Your data, not mine. Your data. Can you see the stag or the inflation? Can you? Right.
Listen. I would legitimately listen to you asking Jay Powell that question for an hour. Like, that is such a good call out. This guy, Jay Powell, just a few months ago, I don't see the stag nor the inflation, and all of us are like,
no, it's here, bro. Listen, even Trump himself admits the economic impact. In fact,
His inflation economic projections out of the central bank this week are stagflation based.
Yeah. Trump tweeted or put on Truth Social this week, like, hey, I think the Fed should have lowered rates because there's going to be an impact by what I'm going to do with tariffs. The administration hate Trump, love him, like him. Nobody's indifferent. They have been very forthcoming that the economy is going to be impacted by the policy they are doing.
Okay, so would you agree that the administration is like, yes, tariffs are coming. They're going to have a short-term.
Yeah, anyone who thinks this is a negotiation tool is smoking crack.
To some degree, but there's a belief here. So in your opinion, the tariff conversation, Trump and the administration are basically telling Powell and the powers that be at the Fed, we're doing this. It's going to have a short term, because they have said this.
Yeah, they said there's
Musk has said it. Trump has said it.
They've been so honest and open about it. I have appreciated that personally.
Howard Lutnick, and again, I have appreciated.
I don't like the way Bassett delivers it in his condescending elite manner.
I would punch him. Like
he's such an elite.
I kid. I obviously kid there.
He's such an elite.
But the way he describes some of this,
they have been forthcoming. They've said there's going to be an economic impact. We value these priorities.
And so Powell's saying, I don't care. I don't care. It's going to be transitory.
But Powell, on the other hand,
define how long transitory is, because I'm willing to bet there's 220 million Americans that can't put food on the table if this transitory let me put it like this. If they make the same policy error here that they made in 22, we're talking about decades of recovery. And that is why you cannot take this conversation lightly.
These people cannot.
And that is why Jay Powell should have been fired on the spot by the administration, which they can't do, but you get my point when he said that, because you're risking decades of recovery, in my opinion here. Inflation, and when you get inflation wrong, it wipes out growth completely. And so I've said for a very long time, you have to always be vigilant against inflation. You have to make sure it's like that evil guy in a scary movie. You got to double tap it to ensure it's down. And Jay Powell and his lackadaisical mentality around this conversation drives me absolutely crazy.
Yeah, I think the Fed's going to screw up here. There
he did.
Let me rephrase. I was referring to the messaging. I think they're going to screw up the messaging and lose the market because it doesn't make any sense. There's no stagflation.
And then you take it beyond that, Mark. You look at their SCP and their reduction in the GDP and their increase in their inflation projection. Even their own dot plot suggests that this environment is not going to be transitory. Like their dot plot suggests that.
Yeah, their dot plot, the SCP, the everything, it doesn't make sense. And when you do not have a message that makes sense, the markets.
Listen, I'm not arguing for a rate cut. I think that would be a mistake right now. But if you're of the opinion that inflation is in fact transitory, okay, and you lower your economic forecast, and the administration is saying it's going to get worse in the short term, if that's your opinion, how are you not cutting? Like and again, I'm not saying I would cut. I wouldn't. But if
that's your actual opinion,
if that is your actual opinion that things are going to be tight in the short term, that economically we're going to see a contraction to a certain extent, inflation, how do you not cut there? And so I don't know how you could look at this policy decision this week in the press conference from a totality of perspective and come away with confidence in this man, Jerome Powell, to lead the most important organization in the United States. I shouldn't even say that. They're not even a U.S. organization. But you get my point. He's
all right. We have to move on from the Fed, but I want to make one more point. I do believe Jeffrey Gundlach put it out, and I've seen it from other sources, that the Fed is setting the stage for QE. I believe this.
Yeah.
There's been two things over the last 3 days with the Fed, which I thought was a sneaky important meeting. We're going to talk about it in future podcasts. Is that one? I thought it was a disaster from a messaging, from any analytical perspective at all. And two, I do believe that Jeffrey Gundlach is right and UBS is right that they are setting the stage, if needed, to launch quantitative easing. Now, they will not call it. At the end of 2019, they launched the fourth phase of quantitative easing. They refused to call it quantitative easing.
Of course they should. Of course.
And so that period, and you go look at the charts.
Still a pig.
You start looking at the charts in September of 2019, it was freaking vertical, right? You had some volatility in the trade war in 2019, and then they launched what was not QE, and it was the fourth episode. They refused to call it QE, but it was QE, and so the markets famously
just for those of you who don't understand necessarily what QE is, the Fed's going to embrace it because in their hubris, they believe it's non-inflationary based. And the reason they believe that is because for 10 consecutive years, they did nothing but quantitative easing, and we had an average inflationary rate underneath 2%. And so there's a philosophy at the central bank, and it's part of modern monetary theory, that basically you can stimulate the markets forever without creating inflation. And for those of that hear that, you're like, oh, we can do this forever without creating inflation. It's like, yeah, but you got to understand that you don't get any of the money. You don't get any of that. You, the listener, you, the end user, you, the American, you, the taxpayer, you, the person that cares the most, you get none of that. None of that. The reason it's not
your life gets worse.
It does. Your dollar goes down in value, even if the price of the goods and services is not going up. And the reason that's the case, Mark, is because where the money in quantitative easing goes. And I made this argument for a very long time. Money is worthless unless it is utilized. And the only way it's utilized is if it goes into the hands of consumers and small businesses and activity in the economy. What quantitative easing effectively does is it's gift wrap money to Wall Street, the banks, the corporate America side of the equation, who can get access to the money. And what they do with it doesn't create a tremendous amount of inflation, because inflation is a matter of the velocity of that money utilized in an economic system. And so, for example, if I give you money, Mark, I guarantee you're going to spend that money. That dollar, that $20, that $50, that $100. Let's say I give you $100. You're going to take that $100. You're going to go buy, McDonald's, and so your money is going to be worth more than $1 to the economy, Mark, because it's going to be worth $1 to you. But when you pay it to McDonald's and McDonald's uses it to pay some of their employees, it's worth $1 to McDonald's, and then it's worth $1 to the employee, and then the employee is going to go buy a cup of coffee with it, and that dollar has more value to the economy if it is utilized. And that's the argument for the velocity of the money. From 2010 to 2020, we didn't have any velocity of money, despite the fact that we were putting more money out there than at any point in human history, because the money was a gift wrap to corporate America and banks through what I would describe as the biggest corporate and Wall Street socialism program that we have ever seen in human history. The rich get richer, the poor get poorer, and the middle class gets dead. That happens in modern monetary theory. QE is a portion of that. They can get away with it because they say things like QE, and no real American understands that. And then Americans will just sit there and yell at each other over the political fiasco, over the politician who creates the inflationary environment, when it's really what the central bank is doing on the back end. I find it utterly disgusting that we are embracing a quantitative easing conversation after years of market appreciation.
We're not embracing a conversation. We're embracing what will be a reality, in my opinion.
I agree. I'm saying it's wrong. It is wrong.
You want to own tech stocks when that happens.
Fine, but it's to me, I have a secondary reason why I talk about these things. I find it's important to understand these from a market participant. Your call out to the 2019 growth environment based on quantitative easing. Absolutely. Market embraces quantitative easing. I'm a big buyer. Listen, that of course.
You have to be.
But I also think it's equally, if not more important, to educate people on what quantitative easing really is.
Yeah.
It is corporate and Wall Street socialism. That's is what it is. And we should fight against that with every being of our body and our soul. If you believe in America, if you believe in fiscal monetary policy, if you believe in Adam Smith and the wealth of nations, if you believe in capitalism in general, if you believe in picking yourself up by the bootstraps, lacing them up a little tighter, getting the job done, having control of your life, you should fight quantitative easing. It is a horrific long-term policy designed to do nothing but gift wrap billions, if not trillions of dollars to the Wall Street institutions.
Yeah, and obviously as that develops, we'll talk. Okay, we're going to get into our 10 bearish arguments. Now, we are going to spend 1 minute each.
Transitory got me yeah, this
1 minute each on these,
okay.
right?
Okay. Gotcha.
So
gotcha. Rapid fire style. Rapid fire, no soapbox.
I'm going to give the argument. You tell me on a scale of 1 to 10 what the short-term impact to the market you think is and what the long-term is. And you have 45 seconds, and then I'll come in for 15 seconds.
Okay, so 10 being this is black swan type risk.
This is super important. You need to pay attention to every detail.
1, like I'm not even thinking about it.
Yes. And so rank him from a short term, and this could be a problem or not a problem long term.
And you have a list of 10?
And I have 10 bearish arguments.
10 bear arguments. Okay.
Oh, the bear case is solid.
Listen, the bulls don't have a case yet.
The bulls have quantitative easing.
They don't have that yet. They don't have a case yet.
But the bears have a really solid macro argument. They really do.
Yeah, now, but a lot of those macro arguments absolutely need to come to fruition for their.
Yes, and that's why we're going to play the game. All right. So no belabored points. We're going to do this 1 minute per subject. First one, the most beautiful word in the English language, tariff. Short and long-term impact.
Short-term impact is an 8. It's really creating a lot of uncertainty on intraday side of the equation. And I think as we get a little bit further down the road and know exactly what the tariff environment is, it starts to become less and less and less important, which means long-term, I see this playing out fairly similar to what we did in the first term. Obviously a little bit choppy, but long-term, I would say it's a 3.
Yeah, no, I don't have anything to add. Generally agree with those rankings. Recession, the possibility of slowing growth or growth worries or recession, they're all talking about the same thing, no matter what worries you use.
Oh, goodness gracious. I'm always concerned about a potential recession because of the obvious economic impact there. In the short term, I don't really give the recession a lot of thought, honestly. I think it's mostly I think it's limited to how people describe certain economic environments. I don't feel we're doing that right now. I am concerned in the short term regarding some of the economic data, but I would say I'm a 4 on the recession side of the equation. Long term, we're going to have another recession again at some point. I'm not Janet Yellen. I believe we're going to have another recession at some point. But I think they're very, very difficult to predict. And I've stopped doing the prediction recession game because if you look at people who predict recessions over the last 15 years, they have the worst track record of anybody that predicts anything. I think my mother, who is hitting in the March Madness bracket, Justice Family March Madness bracket, I think my mother is hitting a higher percentage than people who have predicted recessions in the past. And my mother's not hitting a good percentage right now.
All right. So I generally agree with that. Short term, I think it fades away. Long term, it's a silly game to play. when the data
I don't
becomes
embrace the
that.
long-term game of recession.
Yeah,
Of course,
I
there's
don't.
going to be one.
Number 3, and this has been an ongoing one since DeepSeek, that the AI theme of American dominance of AI, not AI itself, but that the monopoly stranglehold of American techs on AI has been damaged.
I think what DeepSeek has done, and ever since DeepSeek, it's not just been DeepSeek. DeepSeek's been the number one element, the number one that came out of China, but you've seen other ones come out of Baidu and Baba and others as well. I think what DeepSeek did in general is wake America up to where we actually are in this arms race, and it is an absolute arms race going on. I am very concerned long term about America's internal fortitude to be able to invest long term on this side of the equation. I'm not sure there's a more important battle that we are waging from an economic perspective than the AI race with China. Whoever wins that race is going to have a leg up for decades to come. It's going to be very long-term lasting. And so I find that to be extremely important long-term. I think it wakes up the hyperscalers in the US. I think it wakes up people like Elon Musk and Sam Altman and others, Jensen Huang and others. The GTC conference this week, talking robotics and everything. I think it wakes up a lot of the hyperscalers and developers in the US. I think the administration rightly sees the opportunity for us to bring that development home, and they're investing in it. We've seen Apple put in $500 billion. We've seen OpenAI and others up the ante $500 billion. We've seen Taiwan Semiconductor and Intel, and so we've seen a lot of investment coming into the United States, and I think that's going to continue to happen. In general, though, I would say short term, I'm not that concerned. I think there's a lot of fog in war in these conversations. Long term, this is an absolute must. We have to win the AI arms race. And I've said this many times. I'm a fiscal hawk. I support getting our government more efficient and more effective. We've gotten bloated post-pandemic. But if there's one thing that I feel like we should absolutely increase spending on, it's semiconductor production and the race to AI.
Short term, any given day, it can be the only thing that matters to technology stocks. I've seen that in the last couple of weeks with announcements but then that price action has gotten gobbled up immediately. So I think short term, you're going to have to see something. I'm really low. Agree with you on the long term. Number 4. Lots of ways to phrase this, but a administration that does not care about the stock market. Now you could phrase it as
short term. Okay.
Because you could phrase it that the Trump put is not there, right? There's a lot of ways to phrase this in market lingo, right? Like the Trump put's not there, all of that, but it is talked about by everyone.
It's easy as a politician. I don't want to say it's easy, but it's easier as a politician when the market's down 10% to come out and be like, it's just a correction. It's a little bit harder to do that down 20%. So in the short term, I am concerned that the administration has kind of not been a cheerleader for the stock market. Although in the last week, I have started to see the administration start to they're putting Howard Lutnick out there a lot.
Yeah, in the last week they've stopped hating on.
Yeah, they've stopped hating.
Right, let's stop short of the cheerleader.
They're Lutnick needs some lessons on that.
Lutnick should not be allowed in front of the camera. He is not Larry Kudlow.
He's not Larry Kudlow, and people don't trust him because he lies all the time, Mark. That's a problem when it comes to, listen, in politics, that's one thing. From an economic market perspective,
you can't be on that many talk shows doing that many interviews, and
every trader in the world will hate your guts, and they are
market loved Kudlow. Every time Kudlow spoke in 2018,
we were calling him back down, Bob. It's a funny joke.
Dude, the market would go up every time. They need a Larry Kudlow eventually. They'll eventually find one that's not. Listen, it's not Ludwig. I'm with you. I am a 10 in the short term. I think this really weighs on the market. Long term, I'm a 0. The administration.
I'm the same way, because the lower this goes, if it does go, I think you will see capitulation out of the administration on a few things.
All right. I think we're on number 5. Fed speak, and the Fed in general is going to be more of a hindrance than a help to the market. On Friday, to give you a couple talking points, Goolsbee came out, basically said stagflation. He used the word. He found the stag.
He found the stag and the inflation.
Found deflation. Goolsbee found stagflation, throwing it out there. Fed speaker throwing stagflation throughout transitory.
What do you think Goolsbee's response? What do you think he did when he heard Powell say transitory? Like
he's like, yeah, let's do it.
Yeah, I don't know. See, I kind of think I think the Fed collectively went like, oh, Jay. Oh, Jay. Oh, you just made our life harder. I don't think they like that. I didn't. Well, at least if you read the dot plot, they wouldn't like that. Concern over short-term, long-term on Fed talk. Fed needs to shut up. Like,
then you're a 10 on the worry because they ain't gonna shut up.
Like, listen, I could care. Listen, I stopped listening to the Fed when they said transitory.
When you have a Fed speaker, listen, you know that pre-market selling, that was Goolsbee on Friday. Now it got gobbled up right on Friday, but if you have Fed speakers throwing stagflation,
Friday was the biggest bull day last week, honestly.
Yeah, and they held the intraday charts, the whole conversation for another day. But if you have Fed speakers out there slinging stagflation, that's going to wait. That's a big deal in the short term. Long term, they'll just do QE because that's their get out of jail free card. Yeah. All right. Number 6, earnings revisions are starting to turn down, right? And I'm going to read a quote from the newsletter from Matt Justice. While the earnings engine is still running, it's doing so under a cloud of reduced expectations, weaker guidance, and sector-wide downgrades. Number 6, earning revisions are starting to turn down.
Every sector has had downgrades. Every sector has had bigger downgrades than what historically we get. Historically, over 5-10 years, and this is a game in the earnings that happens every quarter. This is not abnormal. It happens all the time. Earnings happens, and then over the next month and a half, earnings revisions for the next quarter come down. It's all the time. And over the last 5 years, we've seen about 3 percentage points come out of expectations, about right around 3.3%. Right now, because of the tariff conversation, which has been the number one stated impact in conference calls, right now we're seeing about a 4% drop in EPS expectations. And so whereas the first quarter was good, we are seeing some a little bit more than normal drops in guidance. We're seeing more than average drops in EPS expectations. Now, ultimately, I think that's negative in the short term. I do believe that sets up the market to have a very good actual earnings season when these companies do beat the low barred expectations, because that's what's happening here, Mark. Every company is artificially lowering their guidance. Every company is being very conservative in their guidance. Every company is now having wide ranges on their guidance. And so the EPS projections coming out is certainly more than what we typically do. Oftentimes, that is an overreaction to the environment, and the environment does not prove out to be that. And so, yes, concern in the short term, I would give it a 7. Concern long term, I would give it a 2.
Yeah, I know. All I know is I already said it's better be better than the Nike, FedEx, Micron price action disaster.
That's fine. I actually had a very positive take on Micron.
Okay, we're going to talk. There are the stocks in the news. So save that for just 5 seconds when we wrap up. 7 and 8. I'm going to tie these together because they basically, 1, building backlash overseas against American brands, which is occurring. And 2, global capital rotating from the United States. Last 2 weeks have seen the biggest foreign selling of U.S. stock in multi-years. Foreign investors hold about a quarter of U.S. equities. Deutsche Bank says they could see up to $1 trillion, Dr. Evil meme inserted here, of foreign equity selling this year.
I don't see a scenario where China outperforms the U.S. economically over the next 5 to 10 years. I do not see a scenario. I do not see a scenario where if you add Europe and China over the next 5 to 10 years, that they outperform the United
My base
States
case on
economically.
U.S. equities is no different than Goldman Sachs. Goldman Sachs sees equities over the next 5-10 years as basically having extremely low overall return.
Okay.
And that is what I see as well.
That's fine, but I guarantee if that's Goldman Sachs' expectation, they don't have Europe outperforming over the next 5 to 10 years.
I think they'll do better than 2%, which Goldman Sachs has. All right. So that's my base case. And
I think that goes against a rich history. Little surprised that you would answer China over the United States.
I think the U.S. stock market is heading for a tremendous bear market.
When you re-listen to this, you're going to want to get some views on that.
Listen, I'm a bear. Like if I'm a bear, and that's not a short-term technical bear, right? I think the market can have rallies. I think traders can make a ton of money on both sides of the equation, but I have serious doubts about the long-term sustainability of the bull market in the coming years. I do, in the U.S. stocks. I'll choose China.
Like I'm not debating that. I am disagreeing with you very, very openly regarding in that environment if Europe and China outperform.
You know what's fun about us disagreeing?
That doesn't make any sense to me, that you can say that the U.S. economy is going to do this, but the world economy is going to offset.
The stock market is going to do that, right?
Well, if the U.S. economy outperforms, so will the market, bro.
I saw someone on CNBC disagree with each other. They basically threw fists. It was funny to watch.
I've seen it a couple times.
All right. 9 and 10. Number 9, the U.S. consumer is showing signs of weaknesses. We're seeing this on a lot of metrics. We have certainly seen it in the confidence numbers. And a lot is made of the partisan nature of these surveys. That has to be acknowledged. But Dems spend money too, bro.
Lots of money. But
so consumer confidence moving forward, short-term, long-term issue as far as its impact on the market.
Consumers are very laggy against economic analysis. I am concerned in the short term on the consumer. You would be crazy not to have some concern on the consumer in the short term. I would say an 8 in the short term on the consumer. Like they need to turn around, or we are going to see some even bigger drops. What I will say though, in the long term, Mark, is I don't have that much concern on the consumer. And the reason I say that is there is a disconnect in what we're seeing in these surveys, in what they're saying about the environment versus what they're doing about the environment. We're seeing a lot of people say that they have no confidence about the environment, but they're still spending money. In that survey you mentioned, you had some radical differences in expectations from Democrats to Republicans. And I mean radical, I mean night and day expectations.
It's silly.
It's so
silly
stupid.
on both sides of the equation.
It should be very concerning for all of us Americans that all of us look at the exact same data, the exact same elements, the exact same process, the exact same environment, and we have night and day interpretations of that. That's not shocking because that's always the case when you bring in politics into economic analysis. But it was still in the consumer side of the equation radical.
Yeah,
but then again, and quite frankly, you had the vast majority, and when I mean the vast majority, I mean the vast majority of Republicans who believe the economy is going to do great, the market's going to go up, inflation's coming down, and you have pretty much 99% of Democrats who think the market is terrible, the economy is going to crater, and inflation's going to get absolutely out of control. And it's like, is that where we're at? Like, one is the ultimate concern and one is the ultimate good. Like, isn't there some gray area from an economic analysis in the middle here? So I have concern in the short term on the consumer. But here's what I believe those Democrats are still going to do over the next year, Mark. They're still going to spend money.
Some money.
They're still going to spend money. They might bitch about it. They might cry about it. They might yell about it, but they're still going to do it. So
Yeah.
like,
Listen, I
long-term,
will
not
believe
as
the
much.
consumers stop spending money no matter what they're at. They only do when they forced to. That thing has been the most consistent trend in economics in America for a
Hundreds
long
of
time.
years, like
A long time, right? And so the sentiment, sure, I worry more about money fleeing from America's stock market than I do about the U.S. consumer spending money. Like they'll spend it if they have it. It's only a question: do they have it?
I I'm still on the China versus U.S. short term versus long term.
It's not hard to beat 2%, bro. I'm sure the Malaysian stock market will do that too over the next 10 years.
To see how you evaluate the world economic engine without the U.S.
It's not. It's return on capital. I do not believe stocks are going to provide it in the United States over the next 10 years. So,
love that.
You know. All right.
I just know for a fact in the next year, I am bringing this conversation up. It is absolutely going to happen.
Every support level that breaks, I'll bring it up to.
Yeah. Yeah.
Red, white, and blue are
okay. All right. Oh, hold on. Mouthy little bear.
That's why the very chart you are showing me is why.
Oh, scary chart going up. So scary. So scary. So scary chart.
Go look at the 70s.
So scary. So consistent. Scary. Oh, so scary chart. Like, come on now.
Yeah.
Long term, you bet on. Long term, you bet on the U.S. economy. There is not a debate on that. There is not a debate on that, and there is not a debate on that. Not just by Americans, Mark. By the world. By the world.
It's why it's people's money. They can do with it as they want. And I'll give that. That is what I love about America. I do whatever I want with my money.
You go enjoy those Chinese valuations that you can trust. You enjoy that. You enjoy that. Here, long term. There's FXI, by the way. Go fight that 200 monthly moving average.
Bro,
go fight that 200. Chart. You're telling me that the SPY chart is worse than this chart?
I am saying that chart is higher in 5 years than the U.S. SPY chart. Yes, that is what I'm saying.
I would not put that opinion on a public channel.
When it's right, I would put it anywhere.
Not right. It's not right.
Oh,
it's right in the short term.
No, it's going to be right for a while.
When Europe or China can outperform in the short term, I'm not surprised it happens. So does any stock in the market. When China or Europe can outperform,
do you want to do stocks in the news term, or not? Like, because we are over time.
Okay, let's do stocks.
We're doing a China segment every freaking week from now.
Listen, I'm a trader. I'm a trend trader. I see the trend here. I also see slowing momentum coming into a massively important resistance.
Oh my God, you short-term technicians sometimes drive me freaking crazy. You know, you sure drive me crazy. NVDA.
You don't like my short-term technical read on your long-term.
Oh my gosh, I'm going to lose my freaking mind. I'm seriously going to go buy a transitory Big Mac, which I never get cheaper again.
Guess what? Pal. A Big Mac you eat isn't transitory the same way that inflation isn't transitory.
Yeah, because it's gone. It never comes back.
No, it doesn't.
I eat the Big Mac. It never comes back.
You deal with the ramifications of that too.
You know, it's gone.
Yeah, it's gone.
Those prices hike. They don't come back down, bro. It's not transitory,
back, guys. We need to get transitory out of the English language.
You know, anyways, NVIDIA, they had a big conference this week. They talked about some cool stuff. It'll be very nice until China invades Taiwan. Really support the company.
That's bullish for NVIDIA.
Yeah. Listen, it depends on where they get their chips made.
In Phoenix.
This is now I am not I don't have a take on NVIDIA, these price levels, this, that, any of that. They unveiled some cool stuff this week. Jensen did his thing, being an amazing leader.
Their new GPU is 50 times faster than their old.
He is one of the best CEOs to ever exist. And I believe that. He is spectacular from a public-facing standpoint. He's spectacular in vision. Like one of the best CEOs to ever exist. He did his job. Price didn't move much. I think that's more market environment than the event itself. What was your take on the event?
A lot of hype, not a lot of follow through.
Okay.
kind of, yeah, like I felt there was a lot of hype coming into the second conference, and the last time they did this, Mark, was kind of the like AI just went boom, 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 boom up. There was a lot of anticipation of what these announcements were going to be, but they didn't do anything besides what the general market was expecting. And so, like,
is that a problem for NVIDIA when you unveil really cool stuff, which Apple would dream of, like,
it's a
unveiling,
problem in the short term, but
and everyone just is like, yeah, well, there's NVIDIA, just
I get it, but come on, like we don't know how tech gets updated over time. Every 6 months, there's going to be new tech, and sometimes we're going to get the, oh my God, did you see that new thing? And then other times it's going to be like, yeah, it's refurbished old tech. I think we're a little spoiled in the AI conversation, honestly. The things that were announced this week were really, really, really cool. I mean, there is going to be robots down the road here just within the next year or two. Some of this technology is absolutely mind-boggling. I mean, they were even talking quantum at the conference, but none of this was not expected. Like every single thing was expected, and so well, maybe not everything. The announcement on like the GM partnership,
was new,
was cool. But I kind of like that for
nice pattern.
GM more than
that's
NVIDIA.
A good pattern, actually.
Like, it actually is a really good breakout.
That's actually a really good pattern.
I think that's something that even Chinese investors can probably invest in on GM is a breakout of $50. But so point is, they failed to inspire. But Mark, a couple of positive things, like those hyperscalers are still spending more.
Yeah, the capex. That's the thing. Until the capex spending actually decreases, it is a theoretical bearish argument.
Well, right? You didn't see it out of the Max 7. They're still,
you just aren't seeing it yet, right? That capex spend is there. As long as the capex spend is there.
To go on your DeepSeek conversation that you asked me about earlier, like Jensen talked about that at the GTC, and he basically says that DeepSeek is not bearish for NVIDIA. Like, they are now starting to develop literally on
you
DeepSeek.
And I have been making this argument. ASML, the Dutch, NVIDIA, semiconductor companies, the DeepSeek is not bearish for these companies. In fact, you can make the argument quite the opposite.
Listen, think about it like this. To get access to 2 years ago AI GPUs, right? Like, it was millions of dollars, millions and millions and millions of dollars. Only a select few of the hyperscalers, the biggest companies in the world, could really embrace this. Now you're seeing more and more smaller companies start to embrace it. And what you're going to see is basically NVIDIA start to sell more than just the big five, you know what I mean? And so I agree with Jensen. I don't think DeepSeek is necessarily a bear argument for NVIDIA itself. Maybe for other areas of the AI trade.
What's funny is I say I have no interest in NVIDIA, and yet almost all of my bullish exposure is in QQQ.
Which is directly tied to NVIDIA. Like, yeah, exactly. You're a weird contrarian sometimes.
Dude, listen, I like tech outperforming here.
All right, what's the next one?
Chinese electric vehicle manufacturer. I kid you not. I'm serious. I have Tesla as the next stock in the news. Now, there's a million things Tesla's in the news for these days, right? That's what you get with Elon Musk. But there was Chinese electric manufacturer BYD announced an ultra-fast charging system capable of adding approximately 250 miles of range. This surpasses
in minutes.
All existing technologies,
not even close,
including Tesla. This was like from an EV standpoint, holy cow. That's yes, technologies invented. This was like next wave. China for the win on this one. But
China, listen, Chinese EV units. I mean, they are putting in a tremendous amount of money into research and development on EV. And I know America doesn't really embrace the EV conversation right now, but we should absolutely embrace the EV technology conversation, because we cannot get surpassed by China there. And we don't want to give things up.
You don't want to, listen, and this, and I did it. I literally, when I prepped this, I didn't have it to bring up China because that was an organic. Matt's China and I debate was an organic one. That wasn't.
Yeah. What I will say on listen, when it comes down to
I wanted an excuse to talk about
when it comes down to betting on America versus any other country, that like I need to get my Constitution up here. You're
such a red, white,
about
and
the
blue.
United States Constitution around these parts, baby. With this, this is literally from when.
Oh my goodness gracious!
We gotta do this the right way.
I'm gonna call Neil Diamond to sing for you here in a second.
Listen, I have cried more than one occasion listening to Neil Diamond sing America. Okay, I have. He's amazing. I love him. Now, all I will say on this EV story coming out of BYD is how is this not seen as positive for the EV space in general? Charging has been a concern for a lot of EV owners. Charging takes up a lot of time. I heard somebody on Twitter just yesterday complaining up a storm about, I got to wait 30 minutes to charge this, and now you can do it take less time than filling up your gas tank. How is this not positive story for the EV space in general? As technology improves, you don't think Tesla and X?
Yeah, I didn't have a take. I wanted to bring up the Tesla chart because I think this is a chart from a cash flow perspective that I will do new credits on, right? Even just from I love oversold conditions that put in 2-week bottoming patterns. Like, I mean, that's the only reason.
No, I get it. Slowing its momentum. I think a lot of development here is needed on the directional side.
Well, yes.
I do see the BYD story as a positive for Tesla, and I think others did too, since Tesla went up on the day it was announced.
Yeah. Well, I think Chinese technology might be catching up, bro.
You can't call Tesla Chinese technology when FXI is at the top and Tesla's at the bottom, bro. You can't do that.
Anyways, Micron, third story, Jensen Wang, Rockstar. My favorite personal CEO is Micron. I thought they delivered a solid earnings report.
Mine's Carpath Palantir.
What?
My favorite.
Oh, he's just fun. Yeah. Like, he philosophicically, like, there's some good,
I'm a big fan.
We both are. Like, just love the human being. Just love the human being. Micron, I like the Micron CEO. He's always been a personal favorite of mine just because he's so honest. Just one of those individuals you just trust. Runs the company very efficiently. Micron type numbers, very solid numbers. Negative price action, but that I felt was more market opening bell nastiness that was carrying through than anything else. Rangy stock, what was your take on the numbers?
It was one of the rare reports last week where, not just last week, but in general with guidance, where it was not just an absolute quote unquote shit show. Guidance has been filthy bad in the last month. As you don't get to 4% EPS projections down, Mark, without some terrible guidance reports coming out. And from Walmart on, there has been some really bad guidance reports. There's only been a couple stocks that stood out to me from a totality of a report perspective, like above the fray. Broadcom was one of them a couple weeks ago. They had a very good report. Guidance was really good. And Broadcom hasn't budged.
Matt, there are things that go into my technology over everything else from multiple angles. And Broadcom, that has weighed on me.
Broadcom is getting in my rankings on tech plays. Like Broadcom,
the tech, I really do think the earnings story is more of a other company than technology.
I voted in Broadcom over Google.
Yeah, like technology, I think their earnings hold up because I think they're running on different gasoline. I think the AI story is alive and well. I think the CapEx story is alive and well. I think and so whatever impact other things have, I think they impact other stocks more than they do technology.
Listen, the AI story is going to be here for the rest of our lives. We're either going to be going through growth stories or contraction phases. Like it's really that. But for me, AVGO, like it stood out. But I also thought Micron stood out a little bit. And I know the price performance. And again, Broadcom, if Broadcom would have reported a week after finance did in Q1, they would have been up 10%, Mark, on that report. The environment of these reports matter. And so you saw the downward pressure on price on Micron on the daily chart following the report. But Mark, when you actually look at the actual report, the report actually broke out on the raw numbers. You had a beat against EPS, a beat on the revenue side, and an increase in guidance. Now, the increase in guidance was wide range. Like you can go from anywhere from saying it was increased by 0.07% all the way up to like 15%. So it was a wide range, but there was good guidance there. And the market was fine up until the cash open. And then on the cash open, it just sunk. And so I don't think you're too confident in Micron on price appreciation until you can break back up above the 200-day moving average. But I'm
confident from a cash flow perspective in this range, as long as that support level doesn't.
Yeah, on the range. I'm just saying, like, if we can get a pivot here, work back up into the 200, this could be a conversation on the directional side. It's got to pivot, get to the 200, but like I thought their earnings was pretty decent, honestly.
Yeah, I think their company, and I know they're a different type of company with their memory chips, but this is a very important earnings report. It's been the most important. This one was more important to me than NVIDIA. I know market was more, because Micron is at the heart of the supply, of AI.
Yeah.
Like, solid.
They're definitely AI infrastructure.
Like, if I'm going to be overweight tech, or basically all weight tech, I can't believe it's like, I need Micron to deliver. I thought they did. Now FedEx did not deliver. And this is what I worry about for companies, right? Just as far as the sentiment. FedEx economic bellwether, lowered guidance. It wasn't a great report. What was your take?
Same. Bad report, honestly. Missed everything. Guidance was dropped. I honestly
7%, bro.
Yeah, it was bad report.
Like, that's a big guidance.
I was honestly surprised it actually got gobbled up.
Market rallied.
Market rallied, and that certainly played a role in it. But by the way, one of the reasons we dealt with the crabby market open on Friday was because of these earnings report gap downs. And so they got gobbled up, market got gobbled up. Honestly, I was a little surprised at that. You had violated a lot on the FedEx here, and I don't know what the buyers were looking at in that.
I wouldn't make anything of the buying. I wouldn't make any of the Micron selling.
No, I don't either. I will make something of it if we gap fill and then doji at 240. Yeah. I'll have a big time opinion on a short there, Mark. Like, this was a bad report.
It was a bad report.
And on any bearish retracement, you're coming into some just nasty resistance.
That is not a good look on a technical level. It's a terrible look. It's a terrible look. All right, Nike, final thing, and then we'll wrap up the podcast. Some of these numbers, and this is what I'm really curious about. Revenue decline expected to be 13 to 17%.
Chinese tariffs, Nike.
And this is where, like, the impact, and this is where I've thought, like, technology is like, yes, makes sense with Nike, right? The amount of business they do is like, we haven't seen the tariff thing work into individual stocks. Nike was like, you certainly saw
You're starting to. The majority of companies reporting earnings are mentioning tariffs. Like, they are. Like, you can't get away from the tariff conversation. If you're in the market, tariffs are one of the annoying conversations we have to have right now. But you're now starting to see it in a lot of the earnings. And in fact, I think FactSet had, and I wrote about this last week in the newsletter, not this previous week, but the week before, about FactSet basically had it that tariffs had basically overtaken inflation as the number one concern out of earnings conference calls.
Out of a current conference.
And so any conference call you're hearing, these CEOs and CFOs are getting questioned on that. Now, Nike, on the raw number side of the equation, like, this was not a bad report, Mark. On the raw side of the equation, Nike about doubled up EPS expectation here. They had like a 92% beat on EPS. They were a very good beat. In fact, one of the better beats on EPS in the entire quarter. The problem for Nike, and the problem for Nike recently has been, anytime their CFO comes out and talks, everybody hits the sell button as fast as they humanly can. And they just had a lot of concern for the future. And they did not, whereas other companies are talking about tariffs as like a transitional phase of it to a certain extent. Like we're just dealing with it right now. We'll see what the environment looks like in a little bit. Nike kind of ripped the Band-Aid off on the tariffs and said it's impacting us. And I don't know. I thought it was a bad look out of Nike. This was a report that, if handled differently by the management team of Nike, you're probably talking at 78 and talking about a potential breakout of the 200-day moving average. I think they stepped on their own results here.
There's two stocks, like, because in the tariff war, right, like you might see certain countries in the United States make deals where there's not others. That's the entire problem. In fact, it's probably probable. If for whatever reason China and the United States play friendly on tariffs, but maybe tariffs with other countries aren't, there's two stocks, Nike and Elf Beauty, that I'm really paying attention to, that are beat up, not terrible valuation, right? You know, companies that I would be willing to put, that if I get specific news on China and the United States, that they've made some kind of deal, whatever it may be, those are two stocks that are on my radar. You know, specifically, you know, if China, United States, that would need to happen though. You know, that would need
that makes sense. Both stocks.
All right. Super fun. I enjoyed that one, Matt. I did too.
Now, for those of you who listen to me and Mark argue every now and then, we actually really enjoy arguing every now and then. Just
Matt enjoys it more than I do, but I have come around over the years.
I enjoyed it more when we were younger.
You know, so because there was a window where I could beat you up, and then that window closed, and I never could again. And
that's true. That's true. But I think when we were younger, bro, all of us Justice Brothers, we would argue for days over the dumbest things.
That's all we do.
Over the dumbest things.
Politics and sports.
We argue for like 3 minutes on important things. Like that's what we do now.
You're old and tired.
Yeah, old and tired.
All right, send us out, bro.
Yeah, if you enjoyed the podcast, best way to support the podcast, give it a like and share on whatever platform you are watching it on. We always put it on our YouTube channel, our X channel, and then obviously on the Trading Justice website itself. So definitely check those out and like and share. And if you have a chance, make sure to watch that Day Trading Mastery webinar I did this Wednesday. Had a tremendous amount of fun, taught a tremendous amount regarding day trading, intraday analysis, and I know you're going to enjoy it and learn and get a tremendous amount out of it as well. And if you're ready to become a pro member of Tackle Trading, we would love to have you as a pro member. Check it out. You can get a free trial there on the Tackle Trading website. 15 days free. Check out the newsletter, the Traders Report, our picks in the Traders Report, all of our Traders Lounges that we do every single day live with our community, where you can ask trading questions, ask cash flow concepts, education, application nonstop. Get in our Coaches Show Cash Flow Club on Tuesday and Thursday, and never, ever, ever sleep on the amazing Tackle Trading newsletter as well. So all of that for the pro, and that's what we call the Tackle Trading Pro membership. You can get a free trial today, 15 days on us, and if you love it, great. If you don't, no harm, no foul. But anyways, I hope everybody has a wonderful rest of your week. Mark, send us out.
I'm going to buy a K-Web t-shirt for next week. Everyone, have a fantastic week.